Topic 1, Section 4, Estimating Asset Returns Using Fundamental Analysis, or IRR, or Forecasted Cash Flows. In this situation, we're not going to use a theoretical model like CAPM, or Global CAPM, or FAMA French, or even historical returns. We're going to look at a completely forward-looking estimate using security analysis. We're going to estimate the cash flows for, say, stock COF. And those cash flows are going to be the current price of the stock. We'll say the current price of Capital One is $83, and it has an estimated cash flow of $10, $10.50, and in the end of the three years, you expect it to be worth $100. Walmart, say the current price is $98, and you forecast these cash flows, including a terminal value, the value of the stock at the end of the third year. And for Brew, say the current stock price is $17, and you estimate these per share cash flows. In that case, all we're going to do is type in the cash flows, make sure the current stock price is a negative, because that would be an outflow, an investment. I expect to get 10, 10.50, and 100. I'll simply take an IRR of that stock investment, and you can see that the expected returns will be based on your fundamental analysis of cash flows, in this case 1468, 566, and 866. I can then go and have a link to that. In my summary of expected returns. And now we have completed the worksheet. Now summarizing, you can see we've used several different models to estimate expected returns. Actually, the first one wasn't a model at all. It just said, I expect the future to look like the last 5 years. Therefore, I expect, say, Capital One to have an expected return of 603. Then I use CAPM. CAPM is a model that says the primary risk measure of an asset is going to be its beta, its sensitivity to the market. We then measured the beta using either a domestic portfolio, the S&P 500, or the global market portfolio, the IOO S&P Global Index. We got those two betas, plugged in our CAPM formula, risk-free rate plus beta times market risk premium for CAPM and global CAPM. So it looks like, in this case, Capital One seems to be having a high return relative to the other assets because it has a relatively high beta, which makes sense for a banking stock. And you can see two low beta stocks, both Walmart and breweries, tend to have low betas and they have low expected returns. However, if I look at the FAMA French model, the returns are quite different. What we saw in Walmart, it had a low book to market and a high market cap, which FAMA French reduced its expected return because of that. On the other hand, the Capital One stock had both had a high beta and then had high sensitivities to small cap returns and high book to market returns, and therefore you get a high expected return. We can also see that using fundamental analysis, if you look at the forecasted cash flows of the stock and take into account the current stock price, you can come up with your fundamental expected returns. So in section 4, we've talked about estimating stock returns using fundamental analysis, or IRR, of forecasted cash flows.